Welcome to the market update of Belvoir Capital for May 2023. Another very interesting month. We've been in the end cycle of the first quarter earnings season, and we've seen almost upward revisions on the earnings side, and this was fueling also the markets towards, especially in Europe, towards new all-time highs. We've seen that in the DAX, and we've seen especially the Nasdaq 100 with the top 5 stocks in that market coming to almost new highs. Nvidia as the foremost example. Everybody's talking about AI these days, and this hype and this momentum drove especially those stocks up to the next levels. We don't know if this is justified or if it's just a hype. We expect now also those, especially those sectors with AI focus, to be a little bit flattening over the next weeks and months, because valuations already discounted a lot of fantasy into the prices. PE levels north of 200. We rather step out of those kind of sectors. On the other hand, we've seen the value depreciating, especially the really good value stocks like Procter & Gamble, Coca-Cola, McDonald's, and so forth. Even Nike, we see kind of a value stock that depreciated over the last couple of weeks, and just only the tech stocks and foremost the AI stocks went through the roof. So what we've seen, S&P was flat. Without the tech stocks, it would have been negative. Same thing to the overall Nasdaq. You take out the top 10 stocks, again, we would have had not such a good month. The DAX came into a new high, as we just mentioned, but couldn't hold it, and we've been even lower for the month, something around 1.5%. What we've seen on the gold side was kind of flattish as well. The new highs almost close to 2,000, but we don't really get over those 2,000 levels, and we came back a little bit. For us, it's a long-term play. It's a diversification out of the inflationary scenario, and that brings us to the macroeconomic perspective, where we see economy is going right now. We've seen, especially in Europe and foremost in Germany, officially a recession, but markets don't reflect that. Why is that? Because markets always are 6 to 12 months ahead. So therefore, we know once we get the numbers for macro, it's already too late to buy the market. And that's what happened this month. We've been to all-time highs, but recession is there. So this is always a time lag. What we've seen in Switzerland, also depreciating stocks, 2% down, the SMI. Don't forget, dividends have been paid, so this has been withdrawn as well, some value out of the index. But we've seen value coming down and growth stocks, especially AI stocks, going up. We see this as a very good entry point for some of the stocks which have been very expensive, especially the value versus growth play was shaking again in between this month. First, value was up and now was down, and then the other way around. Growth was down and was up at the end of the month. So we see the sector rotation, even within a month, is very tough to play. So keep a focus and keep an eye on stocks which can suffer a 5% interest rate, especially in the US, and higher refinancing costs on their balance sheets with great products. So that's what we see. On the other hand, avoid those stocks which are not making earnings, which are in negative territory for the growth cycle, and which cannot cope with inflationary, which will be on a higher level and is not coming down as much as we've seen. Everybody was traveling maybe already in the last couple of weeks. Fare flights is incredibly expensive now, incredibly expensive, and even Lufthansa had to come up and bring the A380 back into work to get enough capacity for the passenger demand for the next couple of weeks. We expect a rather decent next couple of weeks and next couple of months of the summertime, as earnings are through and not much news coming in also from the macroeconomic side. So we stay rather invested in that, what we like, and stay tuned and hope you're going to have a nice summer. Thank you very much for listening.